Hey guys, this is Marcin. I appreciate you guys joining us for this interview. We've got the $1 billion roundtable here with three of my closest business partners. We're actually filming at, I was going to say Ashwood Park Apartments, but as Zorya corrected me, this is called the Burke Apartments today. For those of you who've participated in this property, as investors, you'll look around and you'll realize that this place looks nothing like it did before. Over the next 20 or 30 minutes, we're going to talk a lot about, the progress with this property, broader economic implications of what this property represents, and maybe some of the themes and things that are occurring in the economy and the market. And I've got three of the best people to actually talk about it: Cathy Fontana, Raymond Lord, and Zorya Belanger. So let's kind of go around the horn. Cathy, maybe take a minute or two and share a little bit about your background. I know you're born and raised Texas. We're in Texas. We invest in Texas.
Sixth generation Texan.
Sixth generation?
Sixth generation Texan.
Wow.
Born and raised here. I've been in multifamily for 41 years. I tried to figure out how this came about at one time in my life and figured out it was my grandfather. Okay. He was in real estate. And when I was a very young girl, I remember getting on my bike and running down and collecting rent.
No kidding.
I kid you not. And it all came out in an article a lady wrote, but yeah, so I guess I have been doing it my entire life. Very
cool. And if you were to guesstimate how many apartments you've managed over the years, what are we talking about?
Tens of thousands of doors.
Excellent. And Raymond, how about yourself?
I started in multifamily in 1987 in Southern California.
Okay.
And basically we had a company that specialized in handling really challenged properties. So if they were other companies would not want to touch, hey, they would look at it and go, yeah, that's a little too rough for us. And that's what our company did. And when I left California, I had about 6,000 units. I sold the company to a competitor and moved back to the Midwest. I've been doing it about 35 years, and then got into the acquisitions and dispositions about 23 years ago. And since then, I've done about $3.5 billion of multifamily transactions throughout the region. So mostly Texas, Arkansas, Kansas, Louisiana, as I told you. And then a little bit, we just closed some deals in Georgia, Nashville, Tennessee, and then two in North Carolina. We just, by the way, went into contract on a deal in Jacksonville, Florida.
No kidding.
Yeah, and another one in Georgia. So, yeah.
Very cool. We'll talk about the acquisitions so we got property management, acquisitions, and then Zorya on the asset management side. Tell us a little bit about yourself.
So I started getting into real estate. 2010 was my first property, and then 2013 got really more serious about it. Started with single family homes, and then about 2018 got into multifamily, grew a portfolio in Edmonton in Canada, and then got involved in the larger multifamily in Texas. So.
Very cool. So I got to ask Cathy as a starting point. So sixth generation Texan. We don't have to go far that back in terms of real estate, but you started in the space. It was before the SNL, right?
Yes.
It was before the SNL?
Yes.
Okay. So you had the SNL, you had the Great Recession, and today in 2014, we're sitting in a pretty interesting time.
I like to say I've been through 4 cycles. We had the SNL, Y2K, 08 and 09.
Oh, right, yeah, Y2K.
COVID, and here
whatever,
we go.
Whatever this is.
Whatever this is called.
Maybe let's take a step back. So when you step into a property, how do you figure out where to focus your time first on the property management side?
Well, I usually shop it prior to a due diligence and get to know the employees, the property itself, and get an idea. And when I say I shop it, I don't just shop the property, I shop the neighborhood. I talk to people at the convenience stores, at the local businesses. I talk to the police department. I get calls for service. I talk to code enforcement. I mean, I get out and really talk to the community to find out what's going on with that property before we even think about purchasing.
So as a practical example, when we bought this, because you and I were here together.
Yes.
Initially. I left, I flew back to where I was going. What did you do after? What were some of the things you went through to make sure that we made a good decision here?
Shopped all the local properties around us.
Okay.
Contacted the city, got the 2 years calls for service to this address.
Yeah.
Pulled up the sex offender list to see if we had any at this address. I went to the local stores, the local restaurants, asked people questions. I said, hey, I'm new in town. I was thinking about moving over to this property. What do you think? So you get people talking,
Right.
and man, they'll let you have it.
They'll let you have it, yeah.
They will.
They'll tell you what they think real quick, right? So,
Yes.
And then Raymond, when you came here, because you've done over, was it 3.5? I didn't realize it was 3.5 billion, but yeah, you've done a lot of deals.
A lot of deals.
So when you pull up to a property, what are the things that you're looking for strictly on the acquisition side? And then what were the things you saw that you liked and maybe were concerned about with this deal initially?
Again, before I even set foot on the property, we look at the analytics of the area.
Yeah.
And you gave me some information of your going price point, et cetera.
Yeah.
And right off the bat, I wouldn't have flown down here if it wasn't for that information. And at that point, I said, okay, this is a deal. I looked at it, the age of the asset, the location, the fundamentals in the area, just online analytics.
Yeah.
And then when I got here, then you have to come taste, feel, smell, do all that Cathy indicated. I do the same thing. I come to the property, kind of take a quick look. I go to the neighborhoods. I went to the neighborhood, literally walk the neighborhood and go through the single family homes in the area and just see, how they are. And right off the bat, you go, okay, good demographics, great demographics, great per capita income, right location, good asset that needs a little love, little TLC, and that checks all the boxes. So it just made sense. And that's basically it.
Yeah.
So
when you say per capita income, what does that mean? How does that work?
So you're looking around to go, okay, if we're going to push our rents to this number, is this area, does it support that?
Right.
And it absolutely does. I mean, you're literally looking at rent incomes that are more than 4 times what the rental rates are.
Right.
And so that easily justifies people wanting to be in this area.
Yeah. Zorya, I know when we first tied the property up, we were doing our due diligence, walking around with clipboards and looking around, and we realized that we had to replace or renovate 2/3 of the units, right? So maybe walk us through that experience, because it's been, call it 12 months, and we're almost done the renos, right?
I'd say when I first saw this property, my perspective was like, when it was very, very dated, and it looked bad, but that excited me because I knew that we could just transform it. The structure was good. It would just, it just needed more paint and decor and new floors. And then the whole process for the renovation, that came down to finding a great contractor. Getting the pricing for that. I think more than ever in these times, we have to make sure that we're looking at our costs and having a good construction budget. And we focused on the interiors, like I said, 94 units that we renovated, but also a significant amount to the exterior, because as people, and you can tell that the exterior is important because our traffic really picked up once we got the exterior done. Like, even though we had the model unit, if people are still driving by and see the same property, then they're not going to stop in.
So for context, there's some really nice houses just across the street down the way, which is a really good indicator. I think that's what Raymond was referring to. And Cathy, we're saying that the people that are tenants across the street are wanting to move here now?
Yes, some of the people that are over there, we've had 2 elderly tenants that their children
Oh, that's what it was. They live
their
in that
children
place.
have said, hey, we're going to sell our parents' home. We would like for them. 2 years ago, we wouldn't even have thought about it, but we love what you guys are doing. So we would like to bring them in to live there, and they came and viewed, and they are our new residents. So.
Yeah. So Raymond, maybe I'll ask you this, because I mean, when I started in multifamily and commercial real estate, replacement cost was one of those things that you kind of just you're like, whatever, insurance company needs the replacement cost, who cares? But how has things changed now? Because replacement cost matters.
That it matters tremendously now.
Yeah.
It used to be, we didn't even care what it was. Nobody cared.
Nobody?
Now it's one of the critical components that we look at every time we're looking at an asset. And if those replacement costs, because you see cost on everything going up significantly, you could not replace this property even close to what the acquisition capex is, it's 50 cents on the dollar to your replacement cost. So that is a huge deal. When you start broaching, say 90 cents on the dollar or whatever, okay, that's
You might build new or things like this,
but when you're at 50 cents on the dollar, do the math. It's half off. That's a great deal.
And just for context, guys, we paid $11.1 million for this. It's about 100,000 square feet, give or take, of livable space. Just building out 100,000 square feet, you're easily $200, $250 a square foot. So, built out, finished, whatever. But the point is that you're easily double plus the land cost plus. So that when Raymond says that, that's I think what he's referring to. And maybe let's kind of talk about the opportunity then, because obviously you want to make sure you're buying in a good area, good income. We talked about median income. Cathy talked about the checks, criminal checks, credit checks, sex offender checks. It's necessary. You got to make sure that you've got good tenants. So Cathy, knowing what Raymond was just talking about with replacement costs, looking at opportunities today, how is your approach to buying things potentially changed or evolved compared to maybe 2-3 years ago?
Night and day. We have to come in and really look. The value of this particular asset, we paid in the 70s a door, right? You can't replace this for less than about $1.50 a door. So we have to look at that going in and where we're standing and what condition it's in and where we're bringing it to. And like you said, it's night and day looking at this asset right now, from when we walked through the door to now.
So Raymond, when you look at acquisitions today going forward, has your methodology or your approach changed, say, from even 2-3 years ago?
Yeah, absolutely. So 2-3 years ago, money was so cheap. People were paying ridiculous amounts for what I call, maybe par or subpar assets. And they thought, okay, it's always just going to go up. I think now it's even more critical to do your due diligence, to study the asset, to make sure you're going in the right location, and you've got a right plan for the asset. Each property is going to be a little bit different on what you do, and you have to have that plan and then follow it. And then also, you might change, midstream and go, okay, well, we find if we put a little bit more capital in, our rents can be even more. And that's where you go, okay, this is what we can see. And so it has changed a lot.
Zorya, with this property, we raised the rents, was it an average almost $200 per unit, right? Obviously, we've done a lot of fantastic work, we've done things, but in your mind, what do you think were the things that moved the needle the most for the property?
But definitely the interior renovations, right? We bumped it from $100, sometimes on the 2-bedroom units, $400.
Oh wow, okay.
Because not just because of the renovations, but there's just a lack of 2-bedroom units in our property and in this area. So once we made them look good, we bumped that up quite a bit. Plus we put in the in-suite laundry in about 50 units. So that's another $50 of rent there. So that's what really did it. But then everything, you can't put a dollar value as much in rents for the exterior, but it still has a big impact on it. You can't just renovate the inside.
So when we bought the property, I know traffic was sparse, like there was nobody coming here to look at the property because it looked like, right? So what do we have traffic count now? What is that looking like? Are there a lot of people coming in?
Yeah, we're getting a lot more drive-by, just walking in every day. Some weeks we've had 150 sometimes leads for this property. But marketing is important. And doing it in all different ways, handing out flyers, online marketing, and then we get the drive-bys. But
we market within the community as well. We have 144 sources of marketing here.
Oh,
right?
Yeah, the tenants. Of course.
So we market with them all day, every day.
I've run into a bunch of people just casually looking around. They're happy, they're content, they're comfortable, they like where they're at. They're not huffing and puffing, and they're excited to be here. So that really speaks well. I can't say the same when we bought the property. And do you remember the people that were stopping us? One woman literally stopped Cathy and I. She looked at Cathy. Are you buying this property? Please buy this property.
Please, God.
Literally, please. I remember it was by the
I've
mailbox
lived here
there.
forever, and I want to keep living here, but these people are just awful. And I was like, oh, okay. Well.
Yeah. So I'll share with you guys quickly my thoughts, because when we walked this property initially, I thought to myself, if I could get this for the right price, it would make, like anything else, it would make sense. The challenge we initially had when we first bid on this asset, like so many others, is we were already factoring in higher rates, whereas other buyers were not. So initially we did not get our initial offer accepted, but finally reality set in and we were able to do what was required here. What I saw when we bought this property was we could buy something and renovate it for approximately half of what it would cost to build. You're across the street from beautiful houses, down the street from a power center, super center, up the street from medical plazas, and across the way from brand new condo townhouses that were built. So you've got, to your point, you've got a great median income in the area. People can afford to live here. They're not stressed. They're not financially stressed to be able to afford the rent in the area. And then when you combine all that stuff with the bigger issue, which is no housing. Like there's no housing. Forget about the state of Texas. There's no housing in the U.S. After the 07-08 crash, they never recovered. There was a 3 to 5 million unit deficiency then. They never caught that deficiency up, and it's still lingering today. So I read recently there's a 5 to 7 million unit deficiency currently in the marketplace.
There's approximately 10 years if we went on
That's correct.
10 years
Yes.
till they can catch up with the shortage in the housing that we currently have. There's going to be a deficiency for a while. That just bodes well for B-class assets like Burke.
Well, and when you look at the fact that there's fantastic anchor employers within a 2-3 mile radius of here. You've got the Port of Houston, which is half of the entire petrochemical industry, 20 minutes north. You have Hobby Airport, which you guys will get a laugh out of this. Your backup airport in Houston is bigger than our biggest airport in Canada, just for context.
Well, remember, Houston, is the third largest city?
Yes, it is.
So is it 7 or 8 million people? It's a big shop, right? So there's tons of employment. There's a very strong family-oriented community in this area. So when we saw all that combined together, to me, this made this, again, for the right price, it made it a no-brainer. So Zorya, any lessons or any experiences that this property has kind of taught you, or on the asset management side, or?
Yeah, I've learned a lot.
Where do I start?
Where do I start?
I think in this, especially in this market and the economy is right now, the importance of asset management these days is critical. Like we were talking about buying it at the right price, but if you don't manage it and execute the business plan properly and watch your costs, then it can go downhill. And that's what we've seen of some operators just not watching their asset. And it's more than just, even if you're having weekly calls with your management team, it takes more like being involved and like picking up, manager is perfect, and if there's something that's missing, something needs to be done, then it's about stepping in and getting it done. So it's the age of kind of operations, and so that we can actually get it to the value we need and then carry the business plan, refinance, and sell it at that higher value.
Yeah, no, that makes a lot of sense. I mean, we're almost done renos. We've got, was it 6 or 8 units left for renovations out of the 94 or 96 that it was? Yeah, that's no small feat. I mean, I've seen a lot of projects, think they're going to spend X and they spend X times 3. And I haven't seen that here, which is fantastic. And more importantly, it's actually done. The work is done. The property is beautiful. Obviously, well done to the team there. Raymond, I got to ask you just kind of like some closing thoughts here. So where do you think I actually had 2 questions for you. What is the biggest issue you see people make? Because I also understand that you've been a receiver or are a receiver.
I'm
on
a
assets
receiver,
as well.
yeah.
So for those of you who don't know what that means, Raymond's the guy through his commercial real estate brokerage and his expertise and all the things that he's done over the 35 years. Yep. He literally gets the call to be a receiver on behalf of lenders to help them liquidate an asset, basically recoup as much capital as possible.
Well, typically, the job of a receiver, a lender will call me or contact me, and they'll go, look, we've got a problem, and we've got to fix this. And so we go in there and we look at it, and because we've seen the issues with bad operations and where they don't, follow the fundamentals, our job is to go in there, basically mitigate the damages to the asset, and then turn it around so then it can be resold, usually at a pretty significant discount. The lender's going to take a hit, 20, 25, 35, 45, 50%. It can be a great opportunity, but it's also got its challenges. Of
course.
So you're looking at it going, okay, somebody failed here, and why did they fail? And is it the location of the property? Is it the asset? What happened? Usually it's operations management. So good management, good asset management, good management, critical component to any investment property.
I know there's 100 different ways they can screw it up, but like if you had to bundle it up into 2 or 3 categories, what are like the most common things that you see that people, they end up in the ditch? Why?
They don't properly allocate capital for improvements, or they just let the property slowly degrade into a downward spiral where it just, okay, our rents are too cheap, we can't afford to fix it up, we can't even afford to pay our bills. And then all of a sudden they find the water getting shut off, or just horrific issues with, pest control. There's just a litany of issues operationally that operators just let the property slide into it. Disrepair.
Okay.
One of the number one things I see is they go in and they overdo it.
Yeah.
They walk through the door and they think they're going to live there, right?
Oh.
So that's how their mindset is. So they'll go in and they, we've got to put this kind of this in here and this kind. They're not going to live there. It's a rental property. Mm-hmm. So they overspend, and then they're sitting there going, "Oh my goodness, where'd all our money go?"
And then they find they've only fixed up 10% or 15%.
It's so funny that you say that, because you're right. I've walked properties where you're like, they have stainless steel appliances here, or they have, the marble counters or 3-inch quartz countertops. Like, why? So, Cathy, you've seen this movie once or twice. Interest rates go up, the tide goes out, you see who's swimming naked. Obviously, the old saying with Warren Buffett. Maybe not who, but what do you think is going to be the, I was going to say, who do you think is swimming naked, but the royal who, the proverbial who, where do you think the opportunity is going to be in the next, call it 12, 24 months?
Well, in all the properties that were purchased wrong, and the loans that were done.
Mm-hmm. When you say purchased wrong, though, what is in your mind, like what does that mean?
They overpaid.
Oh, they overpaid. Okay.
They overpaid,
that's definitely wrong.
They over-rehabbed. They went into it again like it was going to be a place where they were going to live, instead of a rental property. You need to make it clean, safe, and functional, right? And anybody who comes into this property goes, wow. And I'm talking not just residents, vendors. They come in with their eyes going, oh my gosh. So that's a really good feeling to know that we've done this, but we did it right. And in every action that we take, it's what's the longevity of this, because it's a rental property.
Yeah.
How long is this flooring going to last? How long is this countertop going to last? Everything that we do, we have to look at for the longevity of it, regardless of what our plan is going in. If it's a 3, a 5, a 7, whatever that plan is, because life is what it is, and it'll hand you what's going to hand you. But going forward right now, we're in that we've climbed to the top, and now we're headed back down, and people are at that I don't want to let go point with those loans, but they're going to have to, because they didn't do it the proper way. I'd say within the next, we're already seeing properties come on the market where you didn't have anything on the market. Now you're seeing a lot of stuff come on, but by 2025, you'll see a lot more come on, a lot better product come on. And it's going to be because people didn't purchase it right.
They didn't buy right. They didn't get the right debt on it.
Right.
I remember I know I was talking to you about this, is people were buying with bridge debt, and they were doing the 3.5% underwriting. Yep. And that's this, and they were basing the value based off that. One of my mentors early days used to say, remember the bull goes up the stairs, but the bear goes out the window. Yeah. So
that's a good one.
In terms of the correction, right? So Raymond, you'd shared with me earlier about one of the strategies you guys have with your team to find listings and opportunities is to look up debt maturities.
Yeah. So you have over the next 2 years $560 billion of multifamily debt coming due.
That's a lot.
That's a lot. So, and that's coming down the pike, and we see it.
Right.
And we're already seeing the murmurings with clients going, hey, what do we do?
Right.
And do we sell? Do we refi? And if we refi, how much capital do I have to come to the table with to keep this asset? And that's literally the analysis. They're going, I've got to come up with $5 million to keep this property to pay down the debt so it has the right debt service coverage ratio, which 2 years ago nobody thought about.
Right.
This is going to happen forever. Well, it doesn't happen forever. It does change. And so those guys that came in and guys and girls that came in and syndicated these deals and put it together, they just bought it wrong, and that debt's coming down.
So when you have clients on the sell side, they come to you for advisory and you help them price an asset or opinion of value, whatnot. The cap rates that you're probably using right now are also higher.
They're higher, absolutely.
So for those of you who don't follow, a cap rate is the value of an asset, and the higher the cap rate, the lower the value. So even if you go, it feels trivial, like 1% doesn't feel like a lot,
Huge.
but 1% against 5% is 20% of the value.
Huge. Case in point, an asset 2 years ago was, say, a 5.5 cap or 5.25 cap.
Right.
We're now at 7.25.
Wow.
Yeah, so that's not 1 point, that's 2
like
points.
a 20-30% erosion of value.
Absolutely. Absolutely.
So you
and that's all a function of debt and also higher costs.
So just let me say this back to you and let me know if I'm correct, but theoretically, if I then went out and bought an asset with a lower cap rate and the cap rate in the market went up, and I actually did my job, Zorya and I knocked out of the park asset management, we increased the revenue, the income, and we increased the revenue by 30%.
Right.
Because the cap rate is now higher, we basically ran our tails off to stand still, right? And that's exactly what's happening.
You're seeing that, yeah.
Wow.
But now, remember, some of these are assets that were financed 10 years ago.
Right.
And, a lot of assets are on Freddie or Fannie loans, and those are 10-year holds.
Right.
And that debt is now rolling over. So, and they're looking at, like you said, 4%, maybe 5% debt that's going into 8, 9, 10%.
Right.
So
they're getting hammered both on the interest rate and then on the valuation.
Correct.
So then next 12, 24 months, the opportunity is to help resolve some of that for some of the people that are going to be not able to refinance.
Correct.
Very
So you're going to see a lot of opportunities over the next 2 years. Call it 25, 26.
Zorya, any other plans on the asset management side for the property here and in general?
And well, we're always looking on how we can increase revenue.
Yeah.
And increasing occupancy is number one, but also other revenue sources. We did the laundry room already and put the in-suite laundry. We've covered parking, reserve parking. We're going to be adding more covered parking, potentially more storage lockers that we can, increase the revenue, and try and look where we can decrease expenses too, right? Just to keep increasing that NOI. Yeah, we've been a lot more on top of our tenants with their like late fees, pet fees, those kinds of things. And I was going to say where a lot of operators go wrong is hiring the wrong property manager and then not getting rid of them fast enough. So I know a lot who've, and the biggest mistake or problem that those property managers do is bring in the wrong tenants, and that's what we saw with the previous owner, right? They had all sorts of people here. They were just letting anybody in, not screening well enough.
And it literally cost them millions of dollars.
Yeah.
Millions of dollars.
Crazy.
And that's one thing people don't understand is they think that a bad tenant is, I missed out on $800 or $1,200 a month. Maybe, but that's the beginning of the story. The knock-on effects are the valuation, the kind of quality of tenant you're going to have in the property that will continue to attract that type of tenant, unfortunately. And then the valuation on the actual financials when you go to refinance or you go to sell. That's literally what happens with a lot of these properties. So.
Cathy's seen this operationally where you let one bad tenant in or two bad tenants in, and you'll have 10 leave, 10 good tenants leave.
That's a really
because
good
they're
point.
going, look, I don't want to be here. You really let a bad apple in here. And whether they're, it's a number of different issues.
Yeah.
And so that screening process is really critical. And it also gives you a higher quality asset, higher quality, and it also makes everybody's job a lot easier.
When I started in the business in 07, 08, we didn't have the syndicator world that we have today. So as much as I love the Jobs Act and what it's done for 506B and 506C, for those of you, I'm just speaking jargon, for essentially everyday people being able to invest in syndications and deals like this. The phenomenon of that was it allowed a lot of people access to deals like this, which is great. But what it also did is it brought a lot of first-time operators into the business that have unfortunately created a little bit more of a kerfuffle than I think they'd ever expected. So what I'm looking forward to in the next 24 months here is really helping bail some of those people out and seeing that through, because that housing shortage isn't going anywhere. And when you combine it with the fact that there's lots of assets like this that are 200 units, 300 units, 400 units, they didn't have the right debt, they didn't have the right, maybe they did the wrong renos, maybe they didn't do the renos, maybe they didn't budget enough for the renos, or a combination of all the things we just talked about. I agree with you guys. I think there's gonna be a lot of opportunity to help people get themselves out of a bad situation and create a tremendous outcome for our shareholders. So I'm really excited that we got this to where it is. The property is fantastic. For the record, neither Raymond or I had nothing to do with the interior design work here.
No,
nothing.
no.
I actually would have fought you guys if you told me blue and gold would have been the colors, but it looks amazing. So this is why you and I stay quiet.
Numbers, financials, yes. This, no.
Yeah, but Cathy and Zorya and the team did fantastic on the renos, the contract work, the everything. I mean, it's fantastic. So I'm really excited for this to be kind of like a signature hallmark for what's possible, because if you look at the before and after what this property was, there are lots of properties across Texas that are literally in this state right now. I really appreciate you guys.